This is my financial disclaimer so I don't get sued. Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be going over the data sets, the SPY technical analysis, and just quickly going over the overall macro for the market for the date of September 10th, 2025. And with that said, let's go ahead and jump straight into the data. So for Tuesday, September 9th, we had the payroll benchmark revisions, and as many of you know already, this was the worst jobs revision in history. Uh, yeah, there's not much more to say about that other than we've been right. We just now need to allow things to play out more and allow more data sets to continue. With that said, um, that's an incredible number. That's saying that essentially there was 900,000 jobs in the economy that weren't really there. Um, that's a lot of jobs. That's very, very substantial. That's going to play a very major role with many of the data sets moving forward from here. Um, I don't think the market was really ready for that, and I don't even think they know what to do with it yet. I think that there is this narrative that the data's wrong, but the data isn't wrong. This is a revision. So how the BLS does their numbers is when they're reporting their job data and everything, they don't have a whole lot of time to collect it. All the participants have to send in their data sets, and they tally everything up, and they do have to do some guesswork along with that initial tally. Which is why we see a lot of downward revisions. I mean, that's literally been how the labor market has been for the last 2 years now. We see a strong number and then a downward revision afterward. Now, I don't think the BLS numbers are wrong here. I don't think there was anything skewing the numbers here. And this isn't accounting for, like deportations or anything else, because you have to remember a lot of those people weren't paying taxes. They aren't even accounted for in this system overall. So when we're seeing our labor market crumbling with the deportations on top of it, that's essentially saying that, this is a double whammy. Um, you now have a labor market that is failing for the people who are paying taxes. And we have essentially cleared out everyone who was working there who weren't paying taxes. So now we have essentially two parts that are getting hit very hard. Something to think about moving forward. I do think that this is going to start dictating a ton of the narrative moving forward from this point. Now, the 3-year no auction came in, and it came in at 3.485%. This is very important because the Fed and the interest rate is based around basically the 2-year uh, the US 2-year yield. And let's just quickly look at that before we go into the rest of the data. Uh, All right, so here is the 2-year yield currently. It is at slightly above 3.5%, currently hovering at 3.556%. It has not entirely broken that downside wedge, but it's getting ready to. Um, but what this says is that our current interest rates are at essentially 4.25 to 4.5 right now, and this is telling us that the interest rates essentially need to be down a full 1% in the very, very short run. Um, with the 3-year yield, this is telling us essentially that this needs to be taken down a whole 1.25% still. And with some of these other data sets, like the 10-year auction tomorrow, the 30-year auction on Thursday, it's really going to start clicking to the bond market and everybody that, okay, we're pricing in the midterm risk, we're pricing in the end term or the long-term risk. And I'm going to define risk in a little bit here when I go over kind of the macro talk, because risk doesn't always mean downside. So yeah, we'll talk about that in a little bit. But anyway, for Wednesday, September 10th, we do have super, super important data in the morning, and it's expected to be cool. The PPI is the Producer Price Index, and it's, this is super key. If this is moving upward, this is telling you that producers are pushing prices higher. If it's moving downward or, holding even, then that's saying that producers are not pushing prices higher, that they are slowing down or cutting down their prices. So the forecast is expecting a slowdown. What does a slowdown mean in the grand scheme of things right now? Um, it means that the whole inflation narrative is out the window. It means that the tariff price increase was a transitory price increase, which means just a single price increase, or basically just a one-time thing. Whether that one time was two price increases within the month or something like that. But for the most part, we should very likely see tomorrow that um, inflation's done, and I'm really, really sad that I think this is going to come in basically at the forecast level or below. Um, we potentially might even see a negative. We'll see. I know that prices in retail stores and everything have not come down yet. Um, but I do know that they have stopped working the prices up. Um, just on the ground level. So that's important. Um, and that's from Kroger, by the way. So not Walmart or anything else like that, but still a very large U.S. retailer, obviously. Now, again, that's at 8:30 a.m. We're expecting a cooler data set. That should be, uh, sorry, I'm losing my train of thought. That should be bearish for the dollar. That should help pull the dollar downward. That should help pull the yields downward. But if the data comes in slightly hotter tomorrow, or even slightly above this forecast amount, I think that the dollar will run hotter. I don't think the yields will run hotter unless we get, some absolute blowout number. Um, yeah, I don't think we'll get the yields running hotter unless we have the percentages start pulling up quite a bit. Sorry, my daughter's singing. Um, the 10-year note auction is at 1 p.m. tomorrow. It's going to be very, 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 very crucial. As I said, this is probably going to be one of the most important auctions of the year. This is going to tell you if the middle end of the curve is ready to respond to the long end and the short end doing what they're doing. Um, I'll probably touch on that a little bit later during the macro talk, as that's kind of a long discussion, but that is discussing basically the spreads between some of these yields. And as those spreads change, it tells you a very, very clear story of what's going on. So tomorrow, obviously, the 8:30 time frame in the pre-market is going to be super, super crucial. The day will be pretty much priced out based on what happens with the PPI. Now, again, the 10-year auction tomorrow could be very, very, very important. It has the ability to cause a lot of weight to shift from equities into the treasuries. Uh, Potentially, this could reignite the treasury bull market. Okay, and I know that sounds silly, but I've been watching the yields and everything very, very closely, and we are nearing the tipping point of the bond market leaving the bearish state. So, um, yeah, that's tomorrow's data. If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime. And getting into the SPY technical analysis, as always, let's turn on the daily time frame and let's quickly go over our moving averages and Bollinger Bands. Now, today, obviously, the payroll data did not pull the market down. We closed essentially at all-time highs. The market closed at 650.33, and the 5 mile is currently at 647.85. So very, very, very likely that's going to be pulling up to the 648.50. So with that said, the upper bounds of the 5 mile is going to be all the way to the 650.50, and the lower bounds is going to be all the way to the 646.50 range. And that 646 range is essentially right where the 10 mile is at. So if we go from the upper bounds, 5 mile, lower bounds, then we can start heading into the upper bounds of the 10 mile, test both those ranges at the same time, test the 10 mile, test the 10 miles lower bounds. From the lower bounds of the 10 mile, we enter the upper bounds of the 20 mile, test the 20 mile, rinse and repeat, so on and so forth. That's how I really focus on my trades, and this way nothing's arbitrary. It's not like I'm having to guess. It's these are actual support levels, and if we know how to read the movement within the moving averages, it tells us a very clear story. Um, I eventually do want to do a video class on it. I know I made a video, I think like almost a year ago now, where I discussed that I was going to discuss how to really read the moving averages and read the Bollinger Bands. That will be coming soon. That's something I really am excited to do, and many people want to watch. So, we will be going over that in a longer video sometime, hopefully soon here. So today we had the earnings from Oracle, and they are expecting something like 450 billion, quarter one projections of something. I don't remember the whole deal. I'll have to read it in the morning when I feel a little better. But anyway, it's absolutely pumping the price. Let's look at this on the 5 minute to really get the full effect of how large of a pump this is. Okay, so here's the 5 minute chart. Um, yeah, it's gone from 240 today. It's actually at 220? No, it was at 234 today. And it's all the way up to 313, 315-ish range in the after hours. This is moving tech a lot. I know in my Sunday video I mentioned that Oracle very likely is going to move tech a lot. It's very hard when Oracle's up 30% in the after hours. That's not a normal movement. With that said, we don't know if this is going to fully carry the rest of tech or not. I know that a lot of tech overnight is up. For example, let's just take a look at NVIDIA, and I will be getting into SPY in just a second. It's just I need to preface the SPY TA with this. NVIDIA, so blind. I apologize, everybody. Here we go. All right, so NVIDIA's after hours. Pretty massive climb. It's up at 173.70 and its price closed at 170.76, so up a whole $3 in the after hours. And for Nvidia, that's massive. That's absolutely huge. Um, but not every tech is getting this weight. Okay, that's something important to understand. We're not seeing a ton of the semiconductors taking this weight. We're not seeing Tesla, for example, absorbing this weight. We're not seeing Bitcoin really absorbing this weight at all. Let's take a look at Bitcoin. Let's turn off the drawings for a moment. We see a little bit of a climb, but this wasn't a very massive climb. This is only a $300 candle. That's really not that huge for Bitcoin. In the grand scheme of things, that's really not a huge candle. So, is this going to cause a upward buy in the tech trend overall? I don't think so. I think that this is going to be very great for Oracle in the short run. Sorry, I'm trying to look for the SPY. Um, I do think it's going to be very great for Oracle in the short run, and based on the charts here, it does look like very likely the SPY is going to attempt to do some upper Bollinger move again if tomorrow's data doesn't pull it down. Okay. And I do want to discuss that because this is a really dangerous zone, and I talked about this in Sunday's video. Uh, but basically this range between the 5 mile and the upper Bollinger, where we don't claim either one of those, is the exact movement we were seeing before the major correction. Okay. Many of us were super, super bullish at that range. I just want you all to remember that. I don't know if I have videos from back then. I think I do. But many of us were extremely bullish at that range. We were expecting the upper Bollinger push. We were expecting all-time highs, all sorts of crazy stuff. And we started getting this really weird in between where we wouldn't go to the 5 mob, but we wouldn't go to the upper Bollinger. We were just kind of sitting in that, I like to call it no man's land, because there's no moving averages nearby. There's nothing to grab onto, nothing to attach to. So it's just kind of hovering in that in between. And that's what I'm seeing right now. Um, but with that said, today was not an upper Bollinger move. Okay. Just making that very clear because I have heard that from a few people that, oh, today was upper Bollinger day one. No, it was not. Okay, we did not close above the upper Bollinger. We did not engage upper Bollinger. Now, with the overnight price being up essentially a whole $1.50, we can open up that upper Bollinger and push into it very, very quickly if we do not have the data come in bad tomorrow. If the data comes in acceptable for the market, then absolutely we're going to have an upper Bollinger day one, day two with the higher high very likely, and then from there we can look for some bear structure. But on the daily time frame, this is telling us that they are working to claim the upper Bollinger, and very likely they will unless the data, basically cancels that out. Now, what else do I want to go over? That's it for the daily time frame. Let's go over the 4 hour. And I know you all see this. If you don't, it's okay. I will show it to you. But there is a very nice bullish cup and handle right here. And we did talk about this in last night's video. Let me go ahead and turn on the drawings. We were expecting the head and shoulders. We started to see that occur and then it had the breakout. Okay, and we talked about that breakout. We talked about how potentially the bulls just needed to hold on. They just needed to buy calls and hold on and allow for that gap to close back up to that 652. And so far with this overnight price action, we are getting ready to do that. Um, we haven't done it fully yet, but we are getting ready to do that. So if that does happen, if the PPI comes in acceptable and we see the market really ripping in the open, that's still room to buy calls, okay? Because as this upper Bollinger pushes further, remember upper Bollinger day one, we expect a close at or above the upper Bollinger. Day two, we expect a higher high. Okay, so potentially we could be going to the 657 range right now. That's still a full $6, $7 upside. So if you're bullish, there's still room to be bullish. However, that room's really shrinking. Okay, you all know my opinion on the upper Bollinger range. I short it. Whenever we get to the upper Bollinger day two, I actively engage in shorting it. Um, I will always do that until the day I die, basically. Uh, that's just my move. Um, but anyway, uh, this isn't a range for me to be bullish in, okay? Because the downside is massive. When we have all of our moving averages below us, when we have things really starting to constrict in here, and by constricting, as you can see, when we were in the upper Bollinger up in here, the bottom Bollinger opened up massively. While the upper Bollinger also opened up massively, and that's what allowed the market to actually continue pushing up. In our range where we're at right now, um, we're really not seeing that. We're seeing it really basically close its teeth on the market and really just getting ready to take it out. That's what it looks like to me. It looks very similar to prior to the correction. Again, we had this very wonky range where we were super bullish up in here. We would barely test that 5 mall, start heading up to the upper Bollinger, get really close to it, and then reject. Okay, rinse, repeat, rinse, repeat, rinse, repeat. We're starting to see a little bit of that. So unless we see the buying pick up massively, then again, I'm going to be bearish here. As long as we hit upper Bollinger Day 2, that's when I take my shorts. And again, if we head down to the 20 mile, that's when you open straddles, prepare for the potential upside again, but also brace for the downside because eventually this is going to fall. That's just how the market works. Eventually we will retest the 200-day moving average. Um, I know it hasn't been a full year since that test, but it's starting to get to the point where another 3, 4, 5 months from now, um, this 200 mod could open up and really, really massively for that downside. And I know everyone's thinking, oh, well, I don't want to have to wait that long for the downside. I get it. I know a lot of you are positioned in like UVIX, SOXS, SOX, all sorts of stuff, SQQQ. You just have to keep holding on and you have to keep engaging the upper Bollinger Day 2 and continue shorting in a smart way. Okay. Um, that's the only way you're going to win this is shorting the best entries, and that's what our upper Bollinger Day 2 really tries to provide is the best entries. You short those best entries, and all you can really do is hope for the best results. Okay, and with that hope, we have our moving averages that we can actually anchor to instead of just arbitrary prices. So that's why I will always short the upper Bollinger Day 2. I am still very bearish on the SPY and tech in general. I think that we are just on fumes and we have been in a massive, massive, massive consolidation range for a very long time now. However, um, again, this can start pushing up to the upside if they really want it to. If they start heading to that 660, that will open up the upper Bollinger and the lower Bollinger and, create some room for some additional price action or that upside if we are going to have that upside. And just going over some macro thoughts. I have put some of those into the video tonight already, but just going over kind of the big picture of what I'm seeing. Okay. Today's job number or, payroll revision obviously was the worst in history. And I know that, again, there's a lot of questions right now with is the BLS data accurate? Is the ADP data accurate? And here's what we can really extrapolate from it as investors, traders, people engaged in the economy and market, is that the BLS has to provide quality information. And why do they have to do that? Um, the BLS is watched not just by Americans, they're watched by literally people all over the world. Pay attention to that data. So the BLS data is extremely key that we keep, the integrity of their organization very, very high. And the same goes with the Fed too. Um, I know that some of these newer members might be kind of hyped up to the media and everything that, oh yeah, we're going to pull the dollar down, we're going to do this, do that. In reality, I think that once they enter the job and once they get into their shoes a little bit, they're going to realize that that's not how things work. Um, and so I'm not questioning this BLS revision. I do think that it was done very thoroughly, especially when everyone's very, very concerned about their own job. Remember, these reports take a whole 6 months to do, and because of that, it's very, very thorough. Okay, these revisions are very, very thorough. Um, so no, I don't question the validity of this BLS report at all. I think it's very, very on point. Um, I don't think that the BLS is going to try to fudge the data. I think that we are going to see a real labor market crisis happen. And with that, I think that we're going to see, a lot of these long end instruments and vehicles really start to take a hit. And what does that mean? That means a lot of these instruments that had to get financed at the high yield. And for example, mortgages. Well, you'd think who would open a 8%, 7% mortgage? Um, well, people who thought that the inflation was going to continue rising at the time. That was the narrative that we were going to go, I believe, to what, 10, 12% at the time people were fearing. So, um, yeah, absolutely. People were trying to buy in and lock in before things got even worse. And so a lot of people, and by people I really mean retail people, and that's non-institutionals. Um, that's basically just the real realtors out there, normal households, normal people trying to make investments. A lot of these people really got stuck in a pickle, and I know that's a fact because I've been reading from a lot of people and watching some videos from a lot of different people where they talk about their depressions where they bought these houses and they literally cannot move them. They've fixed them up. They have, um, done great things with these houses, and they cannot get them sold right now. And with that said, we are going to be seeing the 30-year yields pulling down very, very aggressively very soon. Um, from my basis of what everything is telling me right now, it's suggesting that they want the 10-year yield below 3.5% in the very, very, very near future. And what that's going to do is, I don't want to say crash because that's the wrong word, but it's really going to um, hurt the mortgage market massively. You're going to be seeing a lot of these sellers going under because what's your alternative? That's you file bankruptcy if you can't afford it. Um, if no one's going to buy it for a price where you're going to be made at least somewhat whole, then you're going to end up having to file a bankruptcy on that. And that's kind of just the real truth to it. You're going to have to foreclose on it. And what does that mean? That means that the banks are going to be getting a ton of mortgages again. And what do banks do with mortgages? Well, they do short sales. They get them sold, get it off their books, and you know call it a day. I think very likely we're going to see this happen throughout not just the commercial real estate, but through private real estate as well. It's going to be a very, very massive thing on the country, I think. And um sorry, Silverliner just messaged me. Um no, I'm very concerned. And I think that we all should be somewhat concerned, and I don't mean that in like a fear-mongering way. I mean that in the sense that we're seeing younger people struggling to get jobs. We're seeing the hiring essentially closed. For the most part, the job market is pretty much closed off. Uh, and what does that really do? When the job market's closed off, it gives the power of hiring to the company rather than to the actual person looking for the job and the job seeker. It gives the company the ability to replace people very easily. So if prices are too high within the wages, uh, you cut the people that are, retiring or, you know, leaving the job or whatever, and then a lot of these companies are not replacing those people, or if they are replacing them, they're replacing them with essentially temp hires, which are, very low paying jobs and very short term. So the job market is unsustainable, and it's in a way that it's unsustainable for the majority of just standard living, from, our young adults to our growing families to, our senior citizens and everything. Everybody has been getting hammered. Um, so it concerns me a lot. It's something that even though from a market standpoint, I might have my bets, for example, like TLT. I do have my treasury bets because if the market decides to crash and we have a housing crash or something like that, then TLT is going to go through the roof. Of course I'm positioned in that. Of course I'm positioned in VIX when we're seeing the narrative being very, very weak. Of course I'm going to be in my bear positions. There's absolutely nothing bullish about the market for me right now. Um, One thing that I do think is kind of on the good end of the macro side is that a lot of these new power plants and everything for AI is creating a ton of jobs. I do think that a lot of younger people, and if you're a younger person listening to this, really, really listen. Um, these mega plants and everything are paying construction workers very, very, very well. Okay, you're making great money. You're Yes, you usually have to travel for those type of jobs, but um, these are the type of jobs where there's literally thousands of people on site working on this stuff. Uh, that's the type of job that is super secure right now. Um, I do think that, let me step back. I've been looking at the job market as a whole, and I made that video about a week ago, I believe, where I said that I read through every single page book from 2006 to 2008, and then the last previous beige books I've fully read, which really translates to I've read every single beige book from 2006 to 2008, and then from basically 2020 to current. So, um, I'm seeing a lot of similarities in the beige books right now, basically to that prior to the crash in 2007, 2008. And what does that really mean? That means that we're seeing um, housing construction really fall off. You can't afford the labor anymore. You can't afford the building materials. The houses are devaluing as you're building them, and that's going to cause a major, major issue for the housing market. That's one of the primary concerns with the labor market is the construction workers and, the quote unquote blue collar workers. Um, we've been seeing those jobs falling off. We've been seeing those positions closing. We've been seeing layoffs, and they're hard to track because it's not like a major company doing a layoff, unless it's a major construction company. But when you think construction crews, usually it's a group of, you know, 5, 6, 10 guys who have their boss they know, and they all go get dinner after they work, and it's a small little kind of mom and pop type thing. Um, it's a lot different than a lot of these mega construction companies, and a lot of these crews are really, really suffering. A lot of these crews are holding on to houses that they're having to lose money on just to get sold. Um, that rings a bell with the beige books very, very much. Basically, in leading up to 2008, that was one of the main concerns. And then we had the labor market really hitting just rock bottom during that time. Like we're starting to see now, we're starting to see the real cracks show. We've been seeing those showing since 2023, and if you've been following me, you've likely heard me talking about that. Before President Trump was elected, we were in a similar situation, but we didn't have as much bad job data as we do now. But in 2024, right when President Trump was elected, essentially, we were in a very similar situation as we are now. The market was pushing all-time highs, the yields were starting to drop, we were starting to get a lot of weird and bad news, but the tariffs really kicked that can down the road. And in kicking that can down the road and in trying to project so much strength from our country, we've allowed this, I'm going to call it a crisis, to really just continue building. And yeah, I think that a lot of people are going to suffer because of this. It's not good at all. Um, what are we seeing in the treasury yields and precious metals? We're seeing TLT slash the long end really be picked up. We're seeing HIG, which is essentially a period of 2.83 years. It's either 2.83 or 2.86 years. Sorry, that's my daughter. Um, but it's either the period of 2.83 or 2.6 years, but essentially 3-year period that the HIG is trying to cover for. And here's where I'm going to really discuss risk. We're seeing the market heavily enter into TLT, heavily entering into gold. We're seeing silver being entered into, but slowly starting to taper out a little bit. We're seeing HIG being entered into, but slowly starting to taper out a bit. We're seeing copper moving, but it's actually at the lowest copper to gold ratio ever in history. And what's that saying? That's saying that the long end of the curve is not targeting growth. And why is that? Well, HIG is based on growth. Okay, it is a risk asset to have a somewhat um risk-free yield, even though it's not risk-free entirely. It's a lot less risky than say an equity. But you can think about it kind of like this, and I'm going to talk about precious metals at first. So, what is gold used for? Well, gold is used in you know computers and everything, but it's not massively used in computers and everything. Gold is a vehicle to essentially lock up wealth to survive through um, unprecedented times. Okay. Because you know that during those unprecedented times that the dollar could potentially be devalued, businesses can crash, all sorts of things can happen, but at the end of the day, you're still going to own that piece of gold. Um, what's silver used for? Well, silver is kind of the intimate, the intermediary between copper and gold. You have the store of wealth aspect to it, but you also have the um, growth aspect to it in the sense that tech companies and everybody will be buying up silver when they're starting to see major tech growth. Um, Same applies to copper. Copper will reduce the copper to gold ratio significantly when they're pricing in tech growth and everything over the next 10 years. Excuse me. So what this is telling us is that the next decade isn't projecting growth at all. They're projecting weakness. They're projecting lower yields. They're projecting um, unprecedented risk. And that's what I mean by risk overall, is that everybody says uncertainty, 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 but that's not really what's going on here. I think that everyone's starting to become a lot more certain in what, the long end is telling them. And that's that the treasury yields are heading down into the ground, that um growth is going to slow down because you'd see the copper yield rising a lot more, if not. And it's not. A lot of people are locking up their wealth in gold. Um, Same applies to TLT, and you can essentially think of TLT, pig, and equities in the same way as gold, silver, and copper. So you'd have TLT, which is your gold. You'd have HIG, which is your silver, and then you'd have your equities, which is your copper. Now, when you look at the actual S&P versus TLT, majority of the S&P is vastly under TLT in terms of growth year on year over the last two year period. Even though TLT is being absolutely destroyed and treasuries are in the dirt, but it still shows that a lot of money is just being siphoned into the top echelon of tech, essentially, just the few top mags, and the rest of the market's really just sinking. Um, and I do believe we're starting to see that. We're starting to see TLT pull above big in terms of the actual just spreads, which is also telling us that people are expecting economic uncertainty, and by uncertainty that just means they're not expecting growth. They're expecting growth to really just taper out. So I don't know if it's going to be as bad as I'm talking about, but I do see a lot of signals. I just I'm just seeing a lot of things that are potentially pointing to that direction. So it's good to prepare, and what you can do to prepare is get some positions in gold, get some positions in treasuries. There's nothing wrong with taking a little bit of TLT or taking a little bit of, you know, uh, either physical gold or derivative gold. I think they're both just fine. The derivative value will still hold during some sort of crazy crash, so you don't really have to worry about that one bit. Uh, yeah, it just means that a lot of big money is entering into um, risk-free yielding instruments, which tells me that they're really just going to absolutely destroy the SPY soon. I'm a big bear, and I'm expecting the SPY to really pull down quite a bit because of this. Um, with that said, though, for those of you that have actually been watching me since like the beginning, you know that I'm actually not a bear. I was actually super bullish on this whole rally when most people were wanting to short back at like the 580 range. I was super bullish saying we were going right up to that 630. Um, I did start shorting at that 615 range when we hit the upper Bollinger, but I, I I still agree with my short entries, regardless, even if the market's still pulling up. Those upper Bollinger moves have been very, very precise. So yeah, that's kind of just the macro stuff I wanted to talk about. We're seeing a lot of money moving into these risk-free, um, instruments, and I think eventually that's going to really cause kind of a wave to buy into that. And you have to remember, just looking at TLT, TLT has been in a bear market for multiple years now. Can even go to the weekly chart. It's been in a bear market for multiple years. Uh, Essentially since 2022. Yeah, end of 2022. That's exactly what I was saying. Um, but usually TLT is way higher priced. Um, and I think we are going to start heading back to those not obviously COVID prices, but we are going to start entering back into the lower yield period, I do believe. So, um, that's kind of the spiel for tonight. I hope everyone has a good night, good day. I will talk to you in tomorrow's video, and thank you for listening. Thank you for watching. I always appreciate it. Take care, everybody.